Ladies, friends, gentlemen, bulls, bears, and father. Yes, my dad watches the show. Hi, Dad, and good evening, everyone. It's Recap Tuesday, so it's time for a quick recap. We are in historically the worst week of the year, and the market has done absolutely nothing, just like your local elected politician. The market is finally coming to terms that PayPal isn't a dead stock. I told you so. And you're welcome. The Fed cut rates by 50 basis points for those still living under a rock, aka the homeless bears. And of course, Tom Lee is now bearish.
And CNBC contributor Tom Lee joins us on the phone, sticking with his target of 5,200. Tom, I know you agree the cycle has started and there is a Fed put in place, but it doesn't sound like you're willing at this moment to add a lot more risk.
What the stocks do between now and let's say the election day, I think is still a lot of uncertainty, and that's the reason why I'm a little hesitant for investors to dive in. But if I was going to advise where to be positioned, Carl, it's exactly what you said. It's cyclicals, which is industrials, financials, and small caps.
Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and just like yesterday, another mixed day. The S&P 500 rose to a fresh record high, but not all sectors were equal. Tuesday largely shook off weak consumer confidence readings on the back of semiconductor stocks. Nvidia up 3.96%, pretty much 4%, ABGO, AMD, as well as semiconductor equipment manufacturers. This entire sector was very green of the day. Part of the reason why we also rose 4% was we saw a regulatory filing show that Jensen Huang, the CEO of Nvidia, has finally wrapped up his sales of Nvidia. He sold about $600 million in equities, give or take, and that did actually support overall sentiment today. Other than that, it was quite a mixed day today. For example, you look at stuff like the big names. Infrastructure tech was down, Apple was fairly flat, Google and Meta were very mixed, Amazon, Tesla, a very mixed day across the board. But the worst performing sector definitely here, financials. Visa down 5.49%. Visa is one of the biggest portions of my portfolio, but I've been selling a lot of it recently, mostly because I knew this antitrust was coming and a whole bunch of new competition from central bank instant payments. I think card issuers are going to see a lot of competition in the next 10 years. Other than that, it was sort of like a 50-50 market. Materials was up the most, up 1.4%. Same with consumer discretionary. Industrials up 0.7% and tech up 0.7% as well. The worst performing sectors were generally defensive sectors, so still cyclicals leading the charge, sensitives leading the charge, staples, utilities, and healthcare were all in the red today, particularly utilities. Defensives getting sold in favor of tech, industrials, discretionary, and other sectors. Financials the worst performing sector though, and that was largely due to the consumer confidence reading, as well as some words from Jamie Dimon. He came out and said a lot about the geopolitical situation and that it could get worse. And that type of rhetoric with the consumer confidence reading, as well as some of the price action we saw in credit services with Visa, is actually going to make for financials being the worst performing sector on the day. This doesn't really represent the price action we saw. It was actually a very volatile day. So consumer confidence came out and it suffered its biggest 1 month decline in more than 3 years. It hit 98.7 for September. Economists were expecting a reading of 104, so a huge miss in consumer confidence, and stocks moved sharply lower from their open. We gapped up, most indices gapped up and then moved down. We sort of put a low in the market here very early, and then after we got the Jensen Huang news and some better than expected housing data, like the housing price index actually came in lower than expected. That's a good thing because lower prices probably mean there's more supply on the market. The market then went on to continue its rally, particularly in stuff like the Nasdaq 100 up 0.4% after those lows and peaked to trough nearly 1% on the day. The S&P 500 returned 0.25% and the RTY up 0.17%. But despite all of the commotion we saw here today, stocks did gain across across the factor and size spectrum, except for mid-cap value. They were down 0.19% today. We gained everywhere else. Most of the gain was in the large cap space, and we saw pretty much flat to neutral trading here in the small cap space. Look at value, look at growth. Core the outperformer in smalls, but all in all, it really was a day just for large caps, and I guess to some degree mid caps. But the real winners today were actually Chinese stocks. They stood out because there was huge amounts of stimulus that came out from Beijing to stoke economic growth. US listed Chinese shares, stuff like Alibaba and JD, climbed 7.9% and 13% respectively. Industrial stocks like Caterpillar, as well as stocks tied to China, did really well. Las Vegas Sands jumped 6%, Wynn Resorts added more than 4%. So China was green, and as goes China, so too does Europe. Europe was very green on the back of this. We should see Australia and this part of the Asia region be very green today on the back of that stimulus, and that did support overall price action in the US markets to some degree. And that's why we actually saw what was a global rally, particularly in European stocks and Asian stocks in the overnight session. What also supported stocks today was actually the movement in the dollar. The DXY fell half a percentage point, down 0.55%. Bit of a dumpster fire, still trading at that $100 level, and that did support the overall market today. A weaker dollar means international revenues appear higher on earnings calls. That's going to be good for the third and fourth quarter earnings, and that's why we actually did see large caps outperform, because these stocks have larger international revenues and more diversified global revenues. We saw gold and silver up 1% and 4.66% respectively. Crude up 1.63%. Materials were the best performing sector today, and that's because commodities are rallying. Guys, if you follow me on Twitter, I just added a 1% position in gold. Very interesting. I think we're going to see $3,000 an ounce by mid to end 2025. Great risk to reward right here, and just a way to diversify my portfolio. It definitely was risk on because Bitcoin was up 1.51% today, and what also supported price action across the equity spectrum was yields. Yields fell, the 2-year yield, 10-year yield, 30-year yield. And when yields fall and the dollar falls, that's going to be very supportive for equities, very supportive for commodities, and that's why equities and commodities were the outperformers here today. The S&P 500 up 0.25%, the Nasdaq 100 up half a percentage point, even the IWM smalls up 0.17%. Mid caps were actually flat, slightly down, and we can see some very mixed reactions here in the after hours. All in all, a fairly green day, although certain sectors not quite as good as others. But the S&P 500 just made another new all-time closing daily high. Very bullish in the context of putting in a low, higher low, higher low, new all-time highs, breaking this bearish double top formation that a lot of the bears said, you know, you want to short the neckline right here. Wrong move. We actually ripped to the upside, and that's a new all-time high. Very constructive. Looking at the advanced decline line, another new all-time high in the advanced decline line, the ADL line. That's constructive, and we can see that breadth is actually supporting this all-time high momentum in the S&P 500. Now the gamma chart didn't move at all. Again, I feel like the market is still digesting a lot of the price action, waiting for the data we're going to get tomorrow, the GDP data, the inflation data, the consumption data, the personal outlays data on Thursday and Friday, as well as some of the data we get tomorrow. And that's why we're actually sort of not really doing anything here today. I mean, the S&P 500 up like half a percentage point in the worst week of the year. I get it, but all of that can be derailed on a bad data print tomorrow. We are highly sensitive to the macro because of where we are in the cycle, and just one bad economic data print can derail the markets. And we actually did see that today. I showed you guys this before. This is the 5-minute chart just here today. Okay, the 1-minute chart today. We know we got a bad data print, bad consumer confidence reading. Stocks fell very quickly. So markets are highly sensitive to the overall macro situation, but then we parred a lot of the losses very quickly, sort of around the 11 a.m. midday mark, and then went on to make new all-time highs in the S&P 500. Not much has changed with the gamma situation. We're still at 5600 as a gamma flip. The core resistance hasn't moved up to 5750, and I still favor some mild asymmetrical downside unless we actually see this move up to the 5800 area or the gamma flip flip move up as it is right now. I do favor a tiny bit of a pullback to possibly as low as the 5600 before we make our next move. But again, it's all going to be dependent on what actually happens. Does the 5600 gamma flip move to 5650? Does this move to 5800? But as it is right now, price action does support a little bit of a pullback to these lower levels and price discovery here. And that would be a good thing, because then we can go ahead and make a lower high relative to this and then break these highs and just signal trend continuation. Very similar situation across all of the indices, but instead of new all-time highs, we're trying to see the Nasdaq 100 break above this region right here. The core resistance in the Nasdaq 100 hasn't moved. The gamma chart has not moved at all, and we're pretty much at this level. I think we should see this move up tomorrow, but it really depends on what the option market is signaling. We are in a post-OPEX week, so the volume in options is not really there, and only next week we could see a little bit of volume come into the options market. You know, post-OPEX tends to be a very light week of options trading. Dealers aren't really hedging their books as much, and that's why we don't really see these move in post-OPEX weeks, at least the gamma flip zones. The RSP looks very constructive, and again, you know, I'm buying dips at the 175 171 area, looking for the 200 region sometime in 2025. And then the RTY also in positive gamma, like the Nasdaq 100 and the S&P 500. Although we did see the core resistance right here, we wicked, now we're pulling back. As long as we stay above the 2175 area, very constructive price action in the IWM. It's acting really well, especially after today's data, and I'm a buyer at the 2175 area if we do pull back. But you know, I really do just like the CAF index or small cap quality over the IWM itself. I think if you're going to buy small caps, buy quality, buy names with high return on equity, stable earnings, and healthy balance sheets. In the S&P 500, guys, we are in positive gamma. That means you buy dips, sell rips. You don't take short positions. If we do pull back, we just look for opportunities to buy, and that opportunity is at the 5600. So buy dips, sell rips, and just sit through the volatility. Don't forget, we are in the worst week of the year. The average return this week is negative 0.96%. And so if we do get midweek, end of week volatility, guys, just expect it and buy the dips on the way down. And looking at sentiment, this is the weekend poll. And if you guys want to participate in these, go ahead and subscribe. You'll see them in your feed. This week I asked, which index are you most bullish on? And 40% of you were bullish on the Russell 2000, 26% on the Nasdaq 100, or I should say least bullish on the Nasdaq 100, and 33% of you on the S&P 500. So there's a clear-cut winner. People are bullish on small caps, and there's a clear reason why. Smalls tend to outperform in a cutting cycle. But should you be bullish in this week? Because we are in a very brutal week for the market. September post-OPEX weeks, guys, is actually the worst week in the year, with an average return of negative 0.096, median about the same, 16 wins, 34 losses in the last 50 years. And if you look at the last 5 occurrences from 2019 to 2023, 4 out of those 5 were negative, where 2023 was down 2.93% and 2022 down 4.65%. And if we do get more volatility, don't be surprised. Now, this isn't a crystal ball, guys. Seasonality isn't a crystal ball, but it does allow us to assess probabilities. The probabilities suggest we do sell off in this week, and that could occur on the back end of the week because we do have a lot of data points from GDP, PCE, as well as manufacturing data later on in the week. But we should remain constructively bullish because when we made a 12-month high like we did last week in September, the fourth quarter tends to be very positive. In fact, the full fourth quarter returns from October to December tend to see 4.17% average gain, 24 wins, 5 losses, very bullish. And the majority of this fourth quarter gain actually comes from October 27th to December 5th. So like a 7 to 10 day trading period where we see 3.34% of the 4.147% gain. Very strong gain. So guys, you want to be positioned into this end of year run. I do think we're going to see a blockbuster move to the upside to the end of the year because seasonality does support that and the fundamentals do support that. S&P 500 second quarter year-over-year growth sits at 12.9%. We had a very strong quarter. Guys, have a look at this. Of the 11 major S&P 500 sectors, sectors, 7 of them reported double-digit growth. Com services and information technology reported growth above 20% respectively, and only 3 sectors right here reported negative year-over-year growth this quarter. And the fundamentals of this market cannot be understated. S&P 500 earnings is strong, sector earnings is strong, and as long as the fundamental picture remains robust, stocks will continue to move higher, and there is still plenty of gas left in the tank. This is FINRA margin debt against the S&P 500, and like we did in 2021, normally margin debt follows the S&P 500 higher. That is simply not the case right now. We've seen the S&P 500 move higher, we haven't seen margin debt move higher, telling us that there is still plenty of gas left in the tank, especially as we go into rate cuts. We see that normally in the first 6 months following a rate cut, the S&P 500 returns about 8%, this green line right here, no recession, versus the S&P 500 average of about 4%. I don't think we're going to get a recession, but if you want outsized returns in the next 6 months or the next 6 to 12 months relative to the S&P 500, you actually want to look at quality factors. Stuff like return on assets, return on capital, and return on equity were consistent outperformers above the S&P 500. So this right here is average return relative to the S&P 500. The S&P 500 on average returns about 9 to 10% every single year. After a cutting cycle, a little bit more. If you take this as the average, this amount right here is relative to the S&P 500, meaning that the return on capital is about 18.4%. Return on assets is about 17% nominal. And this is the simple reason why I've championed always buying quality, buying stuff like the Moat Index, wide moat stocks, small cap quality. I've said you always want to keep exposure to big tech because they are huge companies, diversified business models, great balance sheets, and can ride out the storm. And that's why I've always championed quality, because they do outperform, not just in general, but especially in a cutting cycle. The worst places to be according to this data set is stuff like PE to growth, dividend yield, relative strength, and then EPS revisions. So you really just want to be in quality, and they tend to perform in all types of markets. And so you always want to buy high quality assets, but you don't want to overpay for them. Diving into the macro though, guys, looking at the overall economy, we do know why we look at this, because as long as we don't get a recession, equities are going to do really well. But if we do get a recession, that's when things get dicey. And this is the weekly economic index by the Dallas Fed. And guys, they have second quarter revisions at 3.2%. This is very, very interesting because we get the final second quarter revision tomorrow. The GDP is currently sitting at 3%, and the weekly economic index is indicating to us that we're actually going to see a revision to the upside of 3.2%. Is that going to happen? I don't know, but that is what the data is telling us. And if we do get a revision from 3% to 3.2%, that is going to be insanely bullish, especially for stocks, because it totally just wipes away the fears of a recession, and markets will rally, stocks will rally on the back of that. Cyclical stocks, defensive stocks, everything will rally because stocks do well when the cost of capital is coming down and we do get rate cuts. We're in a cutting cycle. At the same time, globally, we're seeing economic data improve significantly. This is the Global Economic Surprise Index moving higher off the lows we made here in August, and this is supporting the price action we have seen in global stocks, the S&P 500, and just markets in general. We're still well below the zero line right here, but we're moving in the right direction. And while economic data is softer than expected, it is a little bit less softer than what we initially thought, and that is a good thing because the market prices in what's going to happen, and if things come in better than expected, the market then has to price that in. Looking at earnings tomorrow, we have Micron. That's going to be the big name reporting earnings tomorrow. We also have Concentrix and Jeffries, but everyone's going to be looking at Micron for a bid into semiconductors, particularly in the memory space. And then after Wednesday, we have Accenture and Costco here on Thursday, guys. And then data tomorrow, the 25th, we just have new home sales and MBA mortgage applications. These are big data prints because they're directly tied to the rate regime. We want to see if new home sales and mortgage applications improve. If they do, we can say that yes, we're starting to see the flow-on effects from lower rates and a lower cost of capital. Then on the 26th, we have durable goods orders. Now the figure here to come in at -2%, and for the most part, durable goods has been in a recession, so this number should come in between -2 and -2.8%. The consensus versus BOFA's estimate. Then we get the final revision for GDP GDP. Now I showed you the weekly economic index is stating a 3.2% revision, over estimate 2.8%. So actually see growth move down. The consensus is 2.9%. So if we actually get anything above 2.9%, I think the market's really gonna like that. And then we also get the PCE revisions as well, that to come in at 2.8%, and then ending home sales at 1%. And then Friday we have the PCE as well as the personal income outlays data, which we'll tackle in tomorrow's video. But catalysts for the week, this is what BOFA sees. Tomorrow, new home sales, the implied move 0.59%, that can really move the market. Then on Thursday, the durable goods data as well as the GDP data, the implied move there is 0.66% to the upside and downside. Then Friday we have the PCE data, roughly the same move, 0.56%. And then on Monday we have a huge implied move right here, 0.97%. They don't have any potential catalysts. I just think the data print on Monday is the Chicago Business Index. That's next week's problem. In the here and now, these are major catalysts, and this is the implied move. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Cheers.